one is Pierre-Yves Laffargue in his hometown,
Thank
GAREAT.
you. Playing on my field. Thank you. So just a quick presentation of the French scheme. You might not all be familiar with that. One must have in mind what is very specific to France is that whenever you issue a property policy covering fire, you cannot exclude terrorism. It's quite simple to keep that in mind. And it put some stress on the market, obviously, and the stress was at its maximum after the World Trade Center at the time. Because of this mandatory coverage, we had in a hurry to find a solution to be able to keep providing insurance, property insurance policies to all of our clients in France. There wasn't any reinsurance capacity left, sort of, at the time. So we set up a private and public partnership on what we call large risks. It was risk over 6 million euros at the time. And we set up that in a couple of months so that at the beginning of 2002, we were ready to keep providing property coverage to the French clients. With the CCR that is involved in that scheme, obviously, and which provides the guarantee of the state, we were able to set up these schemes. Then the scheme changed over time, and in 2006, for example, it was extended as the law extended itself to that peril. It was extended to CBNR damages, so you cannot exclude that, and you have to provide terrorism coverage as well. And the pool is set up, was modified to be able to cover those losses. Now, GAREAT is a non-profit organization as well. It's not an insurance company or insurance company. It's a sort of compensation tool. It's got two different schemes. The main one, the most important, is the large risk section. So it's been operational since the beginning. Now it's covering all exposures over and including 20 million euros in sums insured or indemnity limits. It's mandatory for all companies affiliated to the French Insurance Association. So there's no selection of risk. Everybody would cede to this compensation pool its portfolio and take a share back after reinsurance of whatever liabilities arises out of it. It's got the state guarantee, so the limits, if you want to have the limits in your mind, the market's got a 5 million euro retention, split among the members based on market share. Then we buy reinsurance on the market, and then over a threshold of 2,540 million euros, we are getting reinsurance through the CCR reinsurance that would, it's unlimited. It would include state guarantee. Then there's another section called the small and medium risk. It was added in 2005 when the limit was increased from 6 to 20 million, the limit of the large risk section. The market share there is not the same because it's not mandatory. It's a large number of small risks. The market was sort of able to cope with that. But we felt that there was a need to provide some kind of a pooling facility to small players, let's call them that way, that would have more difficulties accessing to the reinsurance market. So here the market share is around 14%. Now, It's what is important to have in mind is that on the large risk section as well on the small and medium side, there's no adverse selection. It covers property damage and business interruption as a consequence to the property damage losses. The event must happen in France, in the national territories, whatever the cause. It includes now CB&R. There's also a waiver of subrogation against motor liability, because switching one problem to another place is not always finding a solution. So we felt that the market would be better off not to try to introduce a recourse against motor liability, and retrocession is prohibited, not to cause problem on the reinsurance market, a capacity problem. Talking about risk management, we haven't had that many losses over time, hopefully. We're talking here the property damage and business interruption losses. It's up to 34 million in all since 2002. We have we call that risk management. It's more a crisis management, and we're lucky we haven't had to trigger that for now, even though some events happen on the French market. To be able to distribute the liabilities among all the members and manage the cash flow issue in case of a large loss. We have a crisis management also that would deal with all the relevant decisions and external communication with CCR, and together with CCR and public bodies. The benefits is a large mutualization of risks, because it's mandatory, as I explained, to cede all risks, so we're not sharing picking and underwriting specific risk. We get everything or nothing. It's covered from the first euro. We have some reinsurance rate visibility, and it does not impair competition, as it's a percentage of the premium that is to be ceded to cover terrorism. So the basic premium remains on the open market. We get maximal coverage. It's up to the full limit, few exclusion. We got a very low administration cost. It's important. We're not non-profit, so we're trying to spend as less as possible. We get visibility over time, because we have the state guarantee provided through CCR that's granted for a long period of time. It's been 5 years. It's ending at the end of the year, and we are in the process of negotiating the renewal. So it will be over a long period of time again. It's very important for the pool to get some stability in also the buying of reinsurance capacity, because we buy reinsurance capacity. And we got a nice proactive governance with insurer and reinsurers participating to the management of the board. Now to finish, if I still have time, a few challenges. Obviously, as it's been said since the beginning of this conference, the last recent attacks targeted people. So we also ask ourselves, should we adapt and how to this new threat? Whether it's a new threat or not, we don't know. It's an addition. People have always been targeted in the past, as well as property damage. So we are facing the same type of damage, but the new thing is that it's in people's mind on the market. It's targeting more people than property at the moment. So it's something we have to think about. We adapted ourselves to the market. For example, even though we're not getting, it's a pity, coverage through CCR for contingent business interruption. We are providing coverage to the insurance companies that are members of the pool for contingent business interruption. So this comes in addition to the retention that we have in the pool. We have a couple of fields where we're not very comfortable. Rolling stocks, for example. Let's think about tramway networks, for example. They are excluded for now, but if there's a huge loss somewhere in an urban area, it's likely that railway stocks would be hit at the same time. So we have an accumulation of retention potential that we will have to deal with. Now the pool is here to be alive for a long period of time, I'm afraid. It's not the way we set up pools on the market for property. Usually it's been for what we call black swans, black spots that nobody wants, but we have to provide coverage for. Here is something very different, and we are very much counting on IFTRIP to understand more what the problem is, how we can move forward with providing more coverage under a good security scheme. Thank you.
Thank you very much, Pierre-Yves.